Welcome to our channel. Today we're diving into the top 7 habits that can lead you to financial independence. If you're looking to take control of your finances and secure your future, you're in the right place. Let's get started. Seriously though, financial independence isn't some far-off dream that only happens to lottery winners or trust fund babies. It's something that's absolutely achievable for anyone willing to put in the work and, more importantly, develop the right habits. I've seen it happen time and time again, and it all boils down to consistent, smart financial behaviors. Think about it, your daily actions, those small, seemingly insignificant choices you make with your money, they all add up. Over weeks, months, and years, these habits compound, either working for you or against you. The goal here is to make sure they're working for you, propelling you towards a life where you're not constantly stressed about money, where you have options, and where you call the shots. It's about creating a system for your finances that runs almost on autopilot, freeing up your mental energy for other things. So, in this video, I'm going to break down 7 crucial habits. These aren't just abstract concepts, they're actionable strategies that you can start implementing today. We're not talking about getting rich quick schemes here. This is about building a solid foundation for long-term financial health and freedom. It's about empowering you with the knowledge and the tools to make your money work harder for you, so eventually, you don't have to work as hard. Stick around, because this information could genuinely change your financial trajectory. Alright, let's kick things off with the absolute bedrock of financial success: budgeting. I know, the word budget can sound restrictive, maybe even a little bit boring, but trust me on this one, a budget isn't about limiting your life, it's about empowering it. It's the roadmap that shows you exactly where your money is coming from and, more importantly, where it's going. Without a budget, you're essentially flying blind, hoping you have enough at the end of the month, and that's a recipe for financial stress, not freedom. Think of it like this: if you were building a house, you wouldn't just start nailing boards together randomly, right? You'd have a blueprint. A budget is your financial blueprint. It helps you plan, it helps you see potential problems before they arise, and it helps you allocate your resources, your hard-earned cash in the most effective way possible. It's about making conscious decisions about your spending, rather than letting your spending make decisions for you. So, how do you get started? It's simpler than you think. The first step is to meticulously track your income and every single expense for about a month. And I mean everything from your rent or mortgage down to that daily coffee or online subscription you forgot you had. There are tons of apps out there that can help with this, like Mint, YNAB, You Need a Budget, or even a simple spreadsheet. The tool doesn't matter as much as the consistency. Once you have a clear picture of your spending habits, you can start to categorize them. Housing, transportation, food, utilities, entertainment, savings, you name it. This is where the magic happens, because you'll start to see patterns. You might be surprised where your money is actually going. That awareness is the first crucial step towards taking control and identifying areas where you can make some strategic cuts. Now, when you identify areas to cut, it's not about depriving yourself of everything you enjoy. It's about making conscious trade-offs. Maybe you realize you're spending a fortune on takeout. Could you cook at home a few more nights a week and redirect that saved money towards a bigger financial goal, like your emergency fund or an investment account? These small adjustments, when made consistently, can free up a significant amount of cash. There are different budgeting methods you can explore too. Some people love the 50/30/20 rule: 50% of your income for needs, 30% for wants, and 20% for savings and debt repayment. Others prefer a zero-based budget, where every single dollar of income is assigned a job. The key is to find a system that works for you, one that you can stick to. It's not a one-size-fits-all kind of deal. And remember, a budget isn't a static document that you create once and then forget about. Life changes, your income might change, your expenses might change, your goals might change. So, it's super important to review and adjust your budget regularly, maybe once a month or once a quarter. This keeps it relevant and ensures it continues to serve your financial journey effectively. Ultimately, budgeting is about giving you clarity and control. It's about knowing that your money is working for you in the best way possible, aligning your spending with your values and your long-term goals. It's the foundational habit that makes all the other habits we're going to talk about today even more powerful. So, if you haven't already, make creating and sticking to a budget your #1 priority. Okay, moving on to habit number 2, which flows perfectly from budgeting, and that is making saving a non-negotiable part of your financial life. We often hear the advice to pay yourself first, and honestly, it's some of the best financial advice out there. Before you pay your bills, before you buy groceries, before you spend on anything else, a portion of your income should go directly into savings. It's about prioritizing your future self. A common benchmark you'll hear is to aim to save at least 20% of your earnings. Now for some, that might seem like a lot, especially if you're just starting out or have a lower income. For others, it might be too little. The key here is to start somewhere, even if it's 5% or 10%, and then gradually increase it as your income grows or as you get better at managing your expenses through budgeting. The percentage isn't as important as the consistency of the habit itself. The best way to ensure you're consistently saving is to automate it. Set up an automatic transfer from your checking account to your savings account on payday. This way, the money is moved before you even have a chance to see it or spend it. Out of sight, out of mind, but into your savings, that's the goal. This removes the temptation and the need for willpower, making saving effortless. Think about what you're saving for. It's crucial to have different buckets for your savings. First and foremost, everyone needs an emergency fund. This is typically 3 to 6 months worth of essential living expenses, kept in an easily accessible high-yield savings account. This fund is your safety net for unexpected events like a job loss, medical emergency, or urgent car repair, preventing you from derailing your financial progress or going into debt. Beyond the emergency fund, you can have savings goals for other things: a down payment on a house, a new car, a vacation, or further education. Having specific goals makes saving more tangible and motivating. You're not just putting money away into a void, you're working towards something concrete that you value. This psychological aspect is incredibly powerful for maintaining the saving habit long term. Now let's talk about where to find that extra money to save. This is where your budget comes back into play. When you meticulously track your expenses, you'll often find leaks small, regular expenses that add up over time. That daily $5 latte, that's $150 a month or $1,800 a year. Unused subscriptions, those can easily be another few hundred a year. Cutting back on these or finding cheaper alternatives can free up significant cash for your savings goals. It's also about a mindset shift. Instead of viewing saving as a sacrifice, try to see it as an investment in your future peace of mind and freedom. Every dollar you save is a dollar that's working towards your goals, buying you options, and reducing your reliance on a paycheck. It's empowering to see that savings balance grow, knowing you're building a more secure future for yourself. Remember, the habit of saving isn't just for big earners, it's for everyone. Even small, consistent amounts add up over time, especially when you factor in the potential for compound interest, even in a savings account, though it's more pronounced with investing, which we'll get to. The key is to start now, be consistent, and make it an automatic, ingrained part of your financial routine. This habit is a cornerstone of financial independence. Alright, so you've mastered budgeting and you're consistently saving a portion of your income. That's fantastic. But habit number 3 is where things get really exciting. Investing your money wisely so it can grow over time. Saving money is crucial for security and short-term goals, but investing is how you truly build long-term wealth and achieve financial independence. It's about making your money work for you, instead of you always working for your money. Now the word investing can sometimes intimidate people. They might think it's too complicated, too risky, or only for the wealthy, but let me tell you, that's absolutely not the case. Investing is accessible to everyone, and with the right knowledge and approach, it can be an incredibly powerful tool for wealth creation. The key is to start with understanding the basics and aligning your investments with your risk tolerance and financial goals. There are many different avenues for investing. You've probably heard of stocks, which represent ownership in a company. Then there are bonds, which are essentially loans you make to a government or corporation in exchange for interest payments. Real estate is another popular option, whether it's buying property to rent out or investing in real estate investment trusts, REITs. And there are many other opportunities like index funds and ETFs, exchange-traded funds, which are fantastic for beginners as they offer instant diversification. Understanding your risk tolerance is super important before you start investing. Generally, younger investors with a longer time horizon can afford to take on more risk for potentially higher returns because they have more time to recover from any market downturns. If you're closer to retirement, you might prefer a more conservative approach to protect your capital. There's no right or wrong answer, it's about what you're comfortable with. Don't invest in anything you don't understand. One of the most powerful concepts in investing is compound interest, or more accurately, compound returns. This is where your investment earnings start generating their own earnings. It's like a snowball effect. The longer you leave your money invested, and the more it grows, the faster it can continue to grow. This is why starting to invest as early as possible, even with small amounts, can make a massive difference in the long run. Time is your greatest ally in the investing world. For many people, especially those just starting out, low-cost index funds or ETFs are an excellent choice. These funds track a specific market index like the S&P 500, giving you broad market exposure and diversification with a single investment. This means you're not putting all your eggs in one basket by trying to pick individual winning stocks, which can be very risky and time-consuming. Diversification helps to spread out risk. It's also crucial to adopt a long-term mindset when it comes to investing, especially in the stock market. Markets go up and down in the short term. That's perfectly normal. Trying to time the market or chase quick profits through frequent trading is often a losing game for most people. The most successful investors typically buy good quality assets and hold them for the long haul, riding out the inevitable fluctuations. Don't feel like you need a huge amount of money to start. Many brokerage platforms now offer fractional shares, meaning you can buy a piece of a share for just a few dollars. The key is to start, learn as you go, and be consistent. Automate your investments if possible, just like your savings, through regular contributions. This strategy, known as dollar cost averaging, can help smooth out the impact of market volatility over time. Investing is a journey, not a sprint, and it's a habit that pays incredible dividends. Chapter 4. Habit number 4. Break free by avoiding unnecessary debt. Let's talk about a habit that's more about what you do, and that's avoiding unnecessary debt. In our consumer-driven society, it's incredibly easy to fall into the debt trap. Credit cards, personal loans, car loans, the offers are everywhere, promising instant gratification, but accumulating bad debt can be one of the biggest obstacles to achieving financial freedom. It's like trying to swim upstream with an anchor tied to your leg. Now, it's important to distinguish between different types of debt. Some debt, often called good debt, can be a strategic tool. For example, a mortgage to buy a home that appreciates in value, or sometimes student loans for education that increases your earning potential, can be considered investments. However, what we're really focusing on avoiding here is bad debt, high-interest debt taken on for depreciating assets or discretionary spending. Think about high-interest credit card debt. If you're carrying a balance month after month, the interest charges can be crippling. You end up paying far more for an item than its original price, and that money spent on interest is money that could have been saved or invested. It actively works against your wealth-building efforts. The same goes for expensive car loans for vehicles that lose value the moment you drive them off the lot, or personal loans for things you don't truly need. The primary strategy for avoiding bad debt is simple in concept, though sometimes challenging in practice: live within your means. This goes hand in hand with budgeting. If your budget shows you can't afford something without going into debt, then you simply don't buy it, or you save up for it. This requires discipline and a shift away from the instant gratification culture. Delayed gratification is a superpower when it comes to personal finance. If you already have existing debts, particularly high-interest ones, make it a priority to pay them off as quickly as possible. There are a couple of popular strategies for this. The debt snowball method involves paying off your smallest debts first for psychological wins, then rolling that payment into the next smallest, and so on. The debt avalanche method focuses on tackling the debts with the highest interest rates first, which mathematically saves you more money in the long run. Choose the method that motivates you most. Think about the sheer cost of interest. If you have a $5,000 credit card balance at 20% APR, you could be paying hundreds if not thousands in interest over time if you only make minimum payments. That's money that's just vanishing, not working for you at all. Reducing and eliminating this kind of debt frees up significant cash flow that can then be redirected towards your savings and investment goals, accelerating your journey to financial independence. The freedom that comes with being debt-free, or at least free of high-interest consumer debt, is incredible. It reduces financial stress, gives you more options, and allows you to make decisions based on what you want to do, not what you to do to service your debts. It's a massive weight off your shoulders and provides a solid foundation for building wealth. Be wary of lifestyle inflation. As your income increases, it's tempting to upgrade your lifestyle proportionally. Bigger house, fancier car, more expensive vacations. While enjoying the fruits of your labor is fine, if this increased spending is financed by debt or leaves no room for increased savings and investments, you're not actually getting ahead. Consciously decide how to allocate any increases in income, prioritizing debt reduction and wealth building. Avoiding unnecessary debt is a defensive habit that protects your financial future. Chapter 5. Habit number 5 is one that I am incredibly passionate about, and that's the commitment to continuous learning, especially when it comes to financial matters. The world of finance is not static, it's constantly evolving. New investment products emerge, tax laws change, economic conditions shift. Staying informed and continually educating yourself is absolutely crucial if you want to navigate this landscape successfully and make smart decisions with your money. Knowledge truly is power. Think of financial education as an investment in yourself, one with potentially massive returns. The more you understand about personal finance, budgeting, saving, investing, and economic principles, the better equipped you'll be to manage your own financial affairs effectively, avoid costly mistakes, and identify opportunities. You don't need to become a Wall Street expert, but a solid foundational knowledge is indispensable. So where can you find this knowledge? There are countless resources available, many of them free. Read books by respected financial authors, classics like The Intelligent Investor by Benjamin Graham, or The Simple Path to Wealth by J.L. Collins. Listen to reputable personal finance podcasts, follow knowledgeable financial educators and news outlets online. Many universities also offer free online courses on financial topics. The information is out there if you seek it. One key area to focus your learning on is understanding the different types of investment accounts available to you, such as 401, KAs, IRAs, traditional and Roth, and taxable brokerage accounts. Each has different rules, tax implications, and benefits. Knowing how to best utilize these accounts can save you a significant amount of money in taxes and help your investments grow more efficiently over your lifetime. It's also important to learn about risk management and diversification. Don't just chase headlines or invest in the latest hot stock without understanding the underlying fundamentals and risks involved. Learning to do your own due diligence, or at least to understand the advice given by financial professionals, is key. Be wary of get-rich-quick schemes or advice that sounds too good to be true. It usually is. A solid education helps you spot these red flags. Don't be afraid to learn from mistakes, both your own and those of others. Everyone makes financial missteps at some point. The important thing is to analyze what went wrong, learn the lesson, and adjust your approach moving forward. Sharing experiences and learning from a community can also be incredibly valuable. That's one of the reasons channels like this exist, to share knowledge and help each other grow. Make learning a regular habit. Dedicate a certain amount of time each week or month to reading an article, listening to a podcast, or watching an educational video about finance. Even 15 to 30 minutes a day can compound into a significant amount of knowledge over time. The more you learn, the more confident you'll become in making financial decisions. Ultimately, continuous learning empowers you to take control of your financial destiny. It moves you from being a passive bystander to an active participant in your wealth creation. It helps you ask the right questions, understand the answers, and build a financial plan that is truly tailored to your needs and goals. This habit of lifelong learning is an investment that will pay dividends for the rest of your life, far beyond just monetary returns. Chapter 6. Now let's dive into habit number 6, setting clear, achievable financial goals. This might sound obvious, but you'd be surprised how many people are just drifting along financially without a specific destination in mind. If you don't know where you're going, how will you know when you get there? Or more importantly, how will you know which path to take? Financial goals provide that much-needed direction and motivation. Think of your financial journey like planning a road trip. You wouldn't just get in the car and start driving randomly, hoping you end up somewhere nice. You'd pick a destination, map out a route, and figure out what you need for the journey. Financial goals are your destinations. They give purpose to your budgeting, saving, and investing efforts. They are the why behind all the financial habits we're discussing. It's helpful to use the SMART framework when setting your goals: specific, measurable, achievable, relevant, and time-bound. Instead of a vague goal like I want to save more money, a SMART goal would be, I want to save $5,000 for an emergency fund, specific, measurable, by setting aside $417 per month for the next 12 months, achievable, time-bound, which is relevant to my goal of financial security. This clarity makes it much easier to create an action plan. You should have a mix of short-term, medium-term, and long-term financial goals. Short-term goals might be things you want to achieve within the next year, like paying off a small credit card debt, building that initial emergency fund, or saving for a specific purchase. These early wins can provide a huge motivational boost and build momentum for your larger aspirations. Medium-term goals could span the next 1 to 5 years. This might include saving for a down payment on a house, buying a car with cash, paying off student loans, or funding a significant travel experience. These goals often require more substantial savings and a more detailed plan, linking back directly to your budgeting and saving habits. Seeing progress towards these milestones is incredibly rewarding. And then, there are the long-term goals, the big ones, often 5 years out or much further. The most common long-term financial goal is, of course, retirement, or more broadly, achieving financial independence, where your investments generate enough income to cover your living expenses, so work becomes optional. Other long-term goals could include funding your children's education or leaving a legacy. These larger goals often seem daunting, which is why breaking them down is key. Regularly reviewing and adjusting your goals is also crucial. Life happens, circumstances change, priorities shift. What seemed important 5 years ago might not be as critical today. Your income might increase, allowing you to set more ambitious goals, or you might face a setback that requires you to readjust your timelines. Your financial plan should be a living document, adaptable to your evolving life. Write your goals down. Visualize achieving them. Share them with a trusted partner or friend if that helps with accountability. Breaking down large, intimidating goals into smaller, manageable steps makes them feel less overwhelming and more attainable. Celebrate the small victories along the way. Each step forward, no matter how small, is progress towards the financial freedom you desire. Having these clear targets will keep you focused and motivated, especially when faced with temptation or setbacks. Chapter 7. Finally, we arrive at habit number 7, and it's a principle that underpins so much of what we've discussed: living below your means. This doesn't mean you have to live a life of extreme deprivation, eating ramen noodles every night and never having any fun. Not at all. What it means is consciously spending less than you earn, and being mindful about where your money goes, prioritizing your long-term financial well-being over short-term gratification. The gap between your income and your expenses is where true wealth is built. The wider that gap, the more money you have available to save, invest, pay off debt, and ultimately, achieve your financial goals faster. If you're spending every dollar you earn, or worse, spending more than you earn by going into debt, you'll always be stuck on the financial treadmill, no matter how high your income is. I've seen people earning six figures who are broke because their expenses are just as high. Adopting a frugal lifestyle is about making intentional choices. It's about distinguishing between needs and wants, and then optimizing your spending on those wants. Do you really need the latest smartphone the day it comes out, or can your current one last another year? Can you find joy in free or low-cost activities like hiking or library visits, instead of expensive entertainment every weekend? It's about finding value and being resourceful. One of the biggest challenges to living below your means is societal pressure, the dreaded keeping up with the Joneses syndrome. We see our friends, neighbors, or colleagues with new cars, lavish vacations, or designer clothes, and it's easy to feel like we need those things too, often leading to impulse purchases and lifestyle creep. Resisting this pressure requires a strong sense of your own financial priorities and a focus on your own long-term goals, not someone else's highlight reel. This habit of mindful spending supports all the other habits we've talked about. When you live below your means, it's easier to budget because you're not constantly fighting the urge to overspend. It's easier to save a significant portion of your income. It's easier to avoid debt because you're not relying on credit to fund your lifestyle. And it provides more capital for investing, accelerating your path to financial independence. There are countless practical ways to live below your means without feeling deprived. Cook more meals at home instead of eating out or getting takeout. It's healthier and vastly cheaper. Plan your shopping trips with a list to avoid impulse buys. Look for discounts, use coupons, and shop sales. Consider buying quality used items instead of new for things like cars, furniture, or even clothes. Every little bit saved adds up significantly over time. Think of it as a conscious trade-off. By being more frugal today, you are buying yourself more freedom and options in the future. That might mean the freedom to retire early, to pursue a passion project without worrying about income, to weather financial storms without stress, or to be more generous with your time and resources. It's about aligning your spending with what truly brings you long-term value and happiness. Living below your means isn't about being cheap, it's about being smart and intentional with your money. It's a mindset that values financial security and freedom over material possessions. When you master this habit, you gain incredible control over your financial destiny, and you'll find that the peace of mind it brings is far more valuable than any fleeting purchase. This is truly a cornerstone of sustainable financial well-being. Thanks for watching. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more tips on achieving financial independence. Don't forget to hit the bell icon to get notified whenever we post new content. See you next time. Seriously, these 7 habits, budgeting, saving, investing, avoiding debt, continuous learning, setting financial goals, and living below your means, are not just random suggestions. They are the building blocks, the absolute pillars, upon which financial freedom is built. Implementing even 1 or 2 of these habits consistently can make a significant difference in your financial life. But when you combine all 7, their power is amplified, creating a robust system that propels you towards your goals. It won't happen overnight, and there will be challenges along the way. But the key is consistency and perseverance. Start small, build momentum, and don't get discouraged by setbacks. Every step forward is progress. Remember, financial independence is about more than just having a lot of money. It's about having options, reducing stress, and living life on your own terms. It's about having the freedom to pursue your passions, spend time with loved ones, and make choices that align with your values, without being solely dictated by financial constraints. We're here to support you on that journey. So keep learning, keep growing, and keep taking action. Your future self will thank you for it.